everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. So this week's topic is impairment and CGUs and why goodwill cannot exist on its own. So I want to help you students understand why goodwill must be tested within a CGU and not just memorise the rule. So what normally happens is most students memorise that goodwill must be allocated to a CGU and is tested there, but they don't actually understand the why behind it. And if you don't understand the reason, then the CGU questions that you face in your exam can become quite confusing. So what I'm going to do is I'm going to explain three things. So firstly, what a CGU actually is in very simple terms, why goodwill can't be tested on its own, and then the simple logic behind the impairment allocation. And once you see that commercial logic, that commercial side, hopefully the standard becomes much more easier to remember to head into your exam. So back to basics, I think the first key thing to remember is that goodwill is not a physical asset as we know it. It's basically the extra value paid when acquiring a business that we cannot attribute to specific assets. So, for example, you might buy a company for $100 million. When we go through the exercise of finding those identifiable net assets, they're only worth, say, 80 million. So that extra 20 million we calculate to be our goodwill. Now, that extra value represents things like maybe a reputation or brand strength, maybe staff expertise or operational synergies. But what I want you to do is notice something that's really important there. All of those things I just mentioned, you can't sell on their own. You can't sell staff expertise. You can't sell operational synergies. So therefore, you can't sell goodwill on its own because that's what the goodwill is representing. It only exists as part of that wider business. All right. And that is the key idea. So when IAS 36 talks about CGUs, cash generating units, ultimately what a CGU is, in very simple terms, is the smallest group of assets that a business can identify that generates cash independently on its own, a group of assets that generate cash on their own. Okay, so for example, maybe a single retail store might be a CGU, or a manufacturing plant, or a product division. The key point is that the assets work together in that one group to generate cash. And that is what leads us to the reason that goodwill cannot be tested alone for impairment. So we have established that goodwill does not generate cash flows on its own. A brand, a workforce, staff expertise, synergies, they only create value when they are combined with other assets. So let's think about some examples. A brand, brilliant, but without the factories, they can't produce anything. A skilled workforce, brilliant, but without equipment, they can't generate revenue. So IAS 36 says that goodwill must be tested within the CGU that benefits from those synergies, okay, within that group, because that is where the cash flows actually come from, all combined together. And this is why the standard does prohibit testing goodwill alone. So on to the impairment logic. So the impairment test itself is actually quite simple. Okay, so you first calculate the carrying value of the CGU. This includes all of the assets that's allocated to that unit within that group, including the goodwill. And then what you do is compare it to the recoverable amount. And remember, based on your previous studies, recoverable amount is the higher of either the value in use or the fair value less cost to sell. So if that recoverable amount is lower than the carrying amount, that CGU is impaired. Okay, basic concepts back to your FR days. All we need to do now is allocate out that impairment. So seeing hundreds of scripts that I've looked at for SBR, this is one of the key things that students need to remember, and it's the rule around the allocation of that goodwill impairment. So when the impairment happens, it's allocated in a very, very specific order, and that's prescribed within the standards. First thing is we reduce goodwill. Okay, that's the first thing we reduce, and then we reduce all of the other assets proportionately. Okay, but one of the main questions is, well, why do we allocate it to goodwill first? Well, if we think about it, goodwill is the most uncertain asset. Yeah. There's a reason that a fair value can't be allocated to, say, a brand or a workforce. All right. It represents expectations of future benefits. So if those expectations do decline, well, goodwill is the first thing that's going to be reduced. So let's do a very quick, simple example. So let's say we have a CGU with a carrying value of 200. We've calculated a recoverable amount of 170, so impairment is 30. Again, that impairment calculation is very, very simple. 200 take 170 gives us that 30. So we got 30 of impairment. First thing we're going to do is reduce goodwill. So let's say goodwill initially on acquisition was calculated to be 50. Okay, if it was 50, we allocate to goodwill first. That means we can allocate that full 30 impairment to goodwill. Yeah, it's higher than the 30. So that brings us down to 20 of goodwill once we've allocated that impairment. Now, all of the other assets are actually untouched at this stage because the impairment was fully absorbed by that goodwill. So key thing is if the impairment had been larger than goodwill, we'd have allocated that first, dropped that right down to nil, and then allocated the rest out to reduce the other assets on a proportionate basis. So hopefully a nice little thing to remember. If you remember nothing else from this, remember this. So goodwill cannot exist alone because it does not produce cash flows alone. Okay, cash flows come from groups of assets that work together, and that group is what we refer to as a CGU, a cash generating unit. So in an impairment question, what you always need to think is, where do those cash flows actually come from? And that tells you your CGU. So in the SBR exam, the mistake students make most of the time that I have seen is jumping straight into calculations without thinking. Okay. Understand why we're in an exam, stressful environment, get into the maths, get into the numbers, but that's not where the marks are. Okay. So first, I want you to pause and think about it commercially. What is the cash generating unit? Yeah, is it a division? Is it a store? Whatever it might be. And then which assets benefit from the acquisition? And then you can apply those rules. So if you understand the logic behind it, the numbers actually become much easier and the rules become easier to understand and to remember. So most IFRS standards become much easier once you understand the commercial reason behind them. Okay, so goodwill cannot exist alone because the business generates cash flows from groups of assets, not from individual intangible expectations. And then once you see that, CGU impairment questions stop feeling random and you're able to apply that logic in a thoughtful way. Thanks for watching. Hopefully that made the logic behind that standard just a little bit clearer for you. If you found it useful, subscribe for more short SBR technical deep dives. I do post new ones every week. And if you're struggling for SBR and do want support turning that technical knowledge into exam marks, you can find details of my mentoring in the description below. See you on the next one.